Hello, I'm Ryan Lightfoot-Aminoff of Kepler Trust Intelligence, and today I'm joined by James Thom, manager of the Aberdeen New India Investment Trust. James, thank you very much for your time today.
Great to be with you.
Now, the ANII Trust has had very strong performance, both in absolute and relative terms. What's been sort of the key drivers behind this?
Well, I guess in absolute terms, the India market has done very well. So we've had a nice kind of tailwind behind us, which always helps, of course. But as you highlight, the trust has also outperformed the market and the benchmark. And there have been several factors there. But really, if you boil it down, it's all about just very strong stock selection. And that's a case of us as the managers backing our convictions in high quality companies that we're finding across a range of sectors in India at the moment. And if you were to sort of dissect the performance, you'd see that we've had particularly good stock selection in the energy sector, and that's partly a function of us owning a really great small cap company in that sector and choosing not to own the big kind of market bellwether, which is Reliance Industries, which has had a tougher time. So that's been a good decision. And then across other sectors like the industrial sector, the financial sector, and the real estate sector, we've also enjoyed very good stock selection.
And so on that, James, what about your sort of current positioning at the moment? Where are sort of the key underweights and overweights in the portfolio?
So really, for the meantime, we're sticking with what's been working. So when I talk through the drivers of performance this year, we think there's still decent legs to those sort of themes and stocks. So we continue to like the real estate sector, for example, which is in the midst of a very strong upswing, which we believe will be a multi-year upswing, and we're some years into it, but we think that will continue. So continue to hold 2 or 3 real estate developers that have been delivering very strong fundamental performance. Similarly, we think that the capex cycle still has some way to run. It's been predominantly driven by government spending and sort of public sector. It's been a public sector capex cycle, but there are green shoots of a private sector capex cycle coming through as well. So we're positioned around that in several capital goods companies that have contributed to performance already, but we think will continue to do so. And then in the financial sector, again, we've got a broad array of companies that span everything from sort of banks to insurance to online aggregators. But we think that it remains a core position for us across those various subsegments, and we think that the outlook remains bright for those companies as well.
Sure, and with the India market doing so well, many commentators have questioned the valuations of the market. What are your views on valuations, especially in the context of India's longer-term history?
Yes, I think it's a very valid pushback. The India story from a kind of macroeconomic standpoint is a really very compelling one in my view. It's certainly one of the most attractive economies and stories in the region, if not globally at the moment, but quite a bit of that is priced in. So there's a natural kind of concern around whether you're sort of paying too much for the growth that's coming through. I would say there's a few things to think about. One is India has always been expensive. So it has always traded at a premium to other emerging markets and most notably at a premium to China. That premium has widened out a bit, so it's a more expensive kind of market than before. But equally, we've seen that backed with very robust earnings growth. So over the last 2 or 3 years, we've seen close to 20% earnings growth per annum come through. That's moderated a bit this year, but it's still very healthy. So I think that provides the sort of support that you need to see when you're paying the sort of multiples that India is asking of you. It's also driving improving return on equity, and of course that's an important consideration when you're thinking about valuation. So I think, I think that earnings growth because of the attractive macro setup, is pretty stable and should continue through over the next several years. So I don't see any particular reason why there'd be a derating in multiples. But as ever, I think it's down to good stock selection, being active in your approach to the market, and just making sure that you're not overpaying on individual stocks.
Of course, yeah. And one of the other big stories of India this year has been the elections. We had quite a shock result where Prime Minister Modi lost his majority and is now working in a coalition government. As the dust has settled on that decision now, what do you think the outlook is, and has it changed the story for India at all?
I think it has to change the outlook for India. Modi is no longer in sort of sole control, if you like. He's now having to govern through a coalition, which inevitably introduces complexity and I'm sure will slow down decision making as well. So I think it does change the outlook. Having said that, I don't think it does so in a sort of material way. And the evidence so far sort of lends support to that view. So we've seen a lot of continuity in terms of key ministerial appointments from the second term now into the third term. We've had the initial budget that came through post-election in July. And again, there was a lot of continuity in key policy areas there, and in particular, we were very focused on whether the capital expenditure and government spending into sort of infrastructure and affordable housing and these areas was going to continue, and that has, and that's true of other areas as well. So I think there's enough continuity there for you to be reassured that the sort of India story is on track, but on the margin, yes, it does take the shine, I think, off the story a bit.
Okay, and going back to your trust, earlier in the year, we've seen some small changes to the management setup. Have there been any changes in your approach or strategy at all with that?
That's right. So my colleague Christy Fong has stepped down from the trust and indeed from Aberdeen, and Rita has come on board alongside me as my co-manager. And Rita's been with the team now for about a year, and is someone with considerable experience, having spent a number of years in India on both the sell side and the buy side of the industry, and so has a huge amount of knowledge and insight into the Indian market, and has been adding value from day one. In terms of the overall approach and philosophy around the trust, there's been absolutely no change. So we are still a long-term quality-focused trust that's actively managed and conviction-driven. So that's not changed. But Rita, as ever, when you have someone join the team that is new, there's some healthy challenge, some fresh perspective, and that's been really helpful.
And one of the other key advantages of investment trusts is the ability to use gearing. Can you talk us through the history of the gearing and what it currently is on the trust, please?
So we're great believers in using gearing in a conservative way through the investment trust structure. I think it's one of the advantages, as you say, of the investment trust structure. Historically, we have run the gearing at slightly higher levels than it is today. Typically, it's kind of high single-digit percentage net gearing or thereabouts, and at the moment, it's between 2 to 3%. That really reflects that the facility that we have, the debt facility we have in place, has become quite expensive. So the interest costs have risen, and we've seen that the world over, I guess. So we felt it prudent just to bring that gearing down and lower some of those interest costs. But that facility will be will be maturing next year and will be refinanced, and hopefully we can have another look at the appropriate gearing level at that point.
Of course, yeah. And despite the really strong performance of ANII, the trust is currently trading at quite a wide discount. Why do you think this is, and what do you think could be a catalyst for this to narrow?
I think there are a few factors driving it. If you look not just within the kind of India investment trust peer group, but across the sort of broader Asian equity investment trust universe, you can see discounts generally quite wide relative to history on average. And I think that tells you that the asset class is somewhat out of favour. And so the sort of marginal pound or dollar has not been going into Asian equities. They've been going elsewhere, and that's been the case for some time now. And I think India has not been immune from that, despite the fact that, as I said earlier, it's a very compelling story from both a macro standpoint and a bottom-up standpoint. So that's one factor. I think that will change, and it may well be that we're on the cusp of that sort of change now, with US interest rates turning, with it's been a one-way street for so long, but with monetary policy now normalizing, I think the sort of fundamentals that emerging markets like India offer on a risk-reward basis will look more attractive. Meanwhile, the board has been actively buying back shares, and so that I think should help address the the discount as well. And then, as always, it's about performance. And a slight frustration that despite having delivered very good performance, that's not yet been reflected in a narrowing of the discount. I think, provided we can continue, and I obviously hope to continue to deliver good performance over another sort of 6 months, 12 months, whatever it may be, that will get understood and seen by the market, and will result in a narrowing of the discount over time.
Well, one can hope. And on that sort of positive note, we will leave things there. So James, thank you very much for your time today.
Thank you.